I'm assuming she doesn't have the right link yet, because she says she's on, but she's not here. Hello, Ashish. Good to see you. I hope you have a lot of questions today. I'm sick today, and honestly, right after this meeting, I'm probably going to go to bed. Very low energy. You're on mute right now, by the way.
I'm the designated question person today, huh?
Yes, you can be the
So,
question person. And feel free, of course, to put your video on, everybody. It's always great to see faces. Our speaker should be joining soon. I'm looking forward to this talk too, because it's very grassroots. It's very much how do you form a lending club? If you and a couple of other friends want to get together and fund other people's mortgages, how do you do that? And I'll apologize again. I'll probably be coughing a little during this meeting. I'm pretty sick at the moment. And I'll mute my phone too. Alex, are you on yet? She is not. All right, we'll wait here a few more minutes. Anybody have an interesting story to sell? Or investment news or anything that they would like to share?
Well, I'll go. I closed a private funding deal today. We put in a total of $424,000 towards a $615,000 acquisition of 17 acres in Chattanooga. The goal is so we actually collateralized 5 different properties because we were at like 107% LTV, including the $200,000 seller carryback. So we cross collateralized a bunch of properties, but because of the rush and the risk factor in this one, we actually the goal is the operator is going to develop it into 53 single family homes. And I asked for not just our 12% yield on our earnings for our funds, but also to get paid in a house. So I'm pretty excited about that. I never got paid with a house before.
That's pretty good.
Sorry, I was finishing my lunch, so I was not on video.
Anyone have experience with haunted houses?
Oh,
I assume no one has but that would be an interesting story to tell.
What was the question?
Oh, if anyone's had real estate experience with haunted houses.
You know what? I actually do have a story along that line. I found out that my great grandfather built a house out on the Missouri front. And boy, I really should know how to embellish this story a lot better. But apparently there was a murder in my family, and it was part of, it was a direct ancestor of mine. And the house was lived in by the widow for 30 years thereafter. And when she passed away, it sat vacant for a long period of time. And it turns out that Eddie Munster, the guy who played Eddie Munster from the Munsters, found out about this and went and bought the house and turned it into a haunted house museum. And it's in Missouri right now today. My daughter's name actually is the same as the name of the widow that was in the house, Ruby. Her middle name's Ruby. So there's my semi-haunted house story.
Oh my gosh.
Alex is here. Great. Any other
Hello.
opens before we turn it over?
I mean, how do you follow up a haunted house story, Daniel? Like, that's pretty
I don't know. I was on the
impressive.
phone with you when the topic actually came up, so I didn't hear how it got started. But Alex, I will let you know I'm pretty sick today, so I may rely on you guys to carry the conversation a little more.
No problem.
All right, if we have no other opens, then I will just turn the floor over to Alex. And Alex, go ahead and introduce yourself, and feel free to tell about how we met and what we've done together as well.
Sure. So my name is Alex Brashers. For those of you that don't know me, I'm a private lender. I own short-term rentals. I also manage short-term rentals, and I also have invested in LP syndications for multifamily properties. All my properties have now sold, so I'm no longer in an LP position. So now it's exclusively private lending, and short-term rentals for me is my kind of avenue for wealth in real estate. Currently live in Virginia. My spouse is an active duty service member. He's in the Navy. So Uncle Sam kind of has us here. I have a lending business that's actually based in Missouri. I do lend in Virginia and Missouri. And people are like, why do you do that? And I'm like, well, Uncle Sam makes us here, and they don't have an ocean in Missouri, and my husband's in the Navy. So here we are. That is how it came to be. Daniel and I met through a mutual friend, I don't know, several months ago. We were doing a LinkedIn mastermind together with some friends and just kind of hit it off. And we had a lot of the same philosophies about investing passively, having wealth creation through real estate. And I was just like, yeah, these are my people. Kind of when you recognize your people, you recognize your people. So he happened to mention that he has an investing club. We got talking about different things because I run a private lending community online and on Facebook actually. And so we got talking about different things about our clubs and running a club. And it just kind of naturally evolved like, hey, I think people might want to learn something about private lending because I haven't really had anybody come talk specifically about private lending. I won't get into too much of the mechanics about private lending today. This is supposed to be more of just kind of a broad overview. I'm more than happy to answer questions after this as well. I do have a book with bigger pockets that explains kind of really nitty gritty nuts and bolts details. So that's why I won't really necessarily go too deep into the details. It's just because the book is there. There's 80,000 words already written about how to do that. So if you want some more information about the nitty gritty details of private lending itself, get the book and you'll have my contact information. Feel free to reach out anytime. I love talking to people about real estate and private lending, obviously. So if anybody has anything to get started.
We actually shared the link to the book last week, and
nice.
I will share it again right here. It's Lend to Live by Alexandria Brashers.
Yes. So literally lend to live. So that is actually how I make my income is through private lending. You couldn't pay me to be a landlord these days, which is why I was invested as an LP investor. Like I did a couple fix and flips. We did the landlord thing. We thoroughly hated both of them for various reasons, but then we kind of stumbled upon doing the lending component, and that fit my lifestyle and my personality so much better than being a landlord or doing fix and flips. So with that, I will share my screen. Let's see, let's do this one. All right. Can you guys see that? Everybody? Okay, perfect.
Yes, we can.
So if you've listened to anything I've spoken about, with podcasts or seen anything I've written about, I'm really big about investing for your lifestyle, either the lifestyle you currently have or the lifestyle you want. So like I mentioned earlier, my spouse is active duty. So I'm currently sitting in my 21st address in 23 years. We move a lot. So the idea of being able to buy a house everywhere we've lived and then move and then turn it into a rental, which is a very common mantra in the military space, doesn't really fit because some places we were only there a couple months. Like, what are you going to do? The longest until we had moved here, the longest we'd actually ever lived anywhere for the last 20 years was 22 months. That was our record, 22 months. So imagine trying to buy a house, move into the house, and then sell the house all in less than 22 months. So you'll hear me talk about that quite a bit. Now, this is fun. So most people get into real estate, and I don't know why it's this number. If somebody's got insight into this number, please let me know. But people get into real estate because they want $10,000 a month of passive income. Like anytime I speak, I ask people, raise your hand if that was your original goal. You wanted $10,000 a month in income. And the vast majority of the time, good number of hands goes up. And so I'm like, okay, now do the math. How many rentals do you have to get free and clear $10,000 a month? And the same goes with LP syndication investments or, retail investment or industrial investment, whatever you're investing in. how many of those things, how many of those dollars do you have to get to that $10,000 a month? So here's something just kind of I did super quickly. So I actually had a lady, she's like, I don't want 10,000. She goes, I just want an extra 2,000 so I can buy 2 brand new cars. And I was like, cool. Like her and her husband both had a job they really enjoyed. She just wanted an extra $2,000 a month to go buy two new cars. I'm like, okay, well, here's how you can do it. And I broke it down for her, and she's like, oh my God, that's it. And I was like, yeah, that's it. Like, you just have to have $200,000 somewhere. You can put it in a loan, 12% interest gets you $2,000 a month. And so I just kind of kept running numbers with her to show her what she could possibly do. And she's like, yeah, my husband wanted to buy 25 rentals. And I'm like, no, please don't do that. Like, you're going to put a lot of miles on your car getting to 25 rentals. So as you can probably tell, private lending is pure cash flow. It's a cash flow play. Just like every other way of investing, there's upsides and there's downsides. So one of the big downsides people point out with for private lending is, oh, I don't have any tax depreciation. I don't have any write-off. Well, yeah, because you're just getting cash flow that you can actually eat and go home with at the end of the day. That's not to say you can't do private lending and also have some equity positions. Like I mentioned in my introduction, we have an equity interest in short-term rentals. That is our equity play for our tax depreciation component. But at the end of the day, I own a horse. She's very expensive and she eats $50 bills like they're going out of style. So I need cash flow for my household. So if you're wanting cash flow, and the vast majority of investors that I talk to are cash flow investors, they just may not necessarily realize it, but they are cash flow investors. So if you're looking for cash flow, honestly, you can't get anything better than this. Are you going to get the tax depreciation? No. Go buy a couple rentals, go buy a second home or something for your tax benefits, but it's not going to be here. But like I mentioned, you're investing for a lifestyle. So for example, my spouse was stationed in Italy for 2 years. He actually just came home in September, last September, after living abroad for 2 years. I chose not to go because I don't drive. I don't speak Italian. They don't allow dogs or horses. I was just like, no, I'm good. So we were in a long distance relationship for 2 years. And to be able to go over there for a couple weeks at a time periodically, or have him come over here for a couple weeks at a time periodically, we had to have some level of geographic freedom from our jobs. You know, him taking time off or me being able to just kind of bug out of my life for a couple of weeks to be able to go spend time with the person I'm married to. So while I was over there one time, I actually had to fund a loan while we were visiting Austria. And the biggest problem I had was trying to convince the bank in the United States that the phone number I was calling from, which was my husband's cell phone, was actually me, to allow them to wire the money to the closing table. But otherwise, I can do this business from anywhere in the world as long as I have electricity and internet access. This is just a little bit about me, bio slide. Have a book. I'm an active member of the American Association of Private Lenders. They do have some education stuff online if you're interested in getting more kind of a class feel for it. They do have a private lender associate class that they offer online if you're interested in that. I have a Facebook group, Private Lending Lessons. We will be doing some new kind of virtual live events now that the new year started and kicked things off. And then I'm actually a private lender. I lend out my own capital and capital of that in my community, my network, and away we go. So since I'm going to assume that a lot of the people on this call have a little bit of baseline knowledge of real estate. So if you don't, I'm sorry for talking over your head. If you do, I'm sorry. I'm not trying to talk to you like a kindergartner. I'm just hitting the middle of the road here. So if you're not familiar with the term capital stack, think of it this way. If crap hits the fan, who gets paid first? Who has the greatest claim to the money? So in a capital stack where you're a private lender, you are at the bottom, which is actually where you want to be. So if you have a first lien, that means if something were to happen, the borrower stops paying, they default on some aspect of the note, they stop having insurance, they go MIA, whatever the situation is, you actually have first claim to that asset to be made whole. The further up the capital stack you go, the less claim you have to the money should the deal go sideways. So since we might have some people that are that have invested as an LP syndication, just to give you an idea, if you are an LP syndication, you're actually investing in the owner equity component. You're in this block up here. Granted, just like I said before, there's pluses and minuses. The first lien holder, you don't get the upside of appreciation like you do as owner equity. You don't get the tax depreciation like you do as owner equity. But I particularly like the cash flow and the safety of being here in the lender's position. So just to kind of give you a frame of reference of what we're talking about, we are at the bottom of the capital stack. We are first liens. We are first mortgages on a property. So you might be asking, where does private lending fit in? Like, what is this magic voodoo? Because there's banks. Why aren't investors just going to the banks? Or why don't investors just go to these hard money lenders or something like this? Why do they need people like me? Why do people like me exist? Well, basically, we can do things faster, usually cheaper, less paperwork. Not to say we're not doing underwriting, but less paperwork in general. If you've ever had to buy a house, you understand how much paperwork you had to submit to buy that house. And also, these tend to be shorter loans that are interest only. They have some sort of balloon component at the end of them, usually at the 12-month mark. And then usually we have a borrower entity. So if you've tried to buy a house, for example, your primary residence, they're not going to let you buy your primary residence in an LLC. Whereas something like this, we actually encourage you to go buy a property in some sort of business entity. I'll say LLC, but it could be any type of business structure. And then people always ask, they want to know, how is my money protected? What are some common, what is my expected return? So generally, there's a couple different ways that a lender is going to make money doing this transaction. So first one that most people don't think about for private lenders like myself is origination points. Again, if you've bought a house, you potentially paid some origination points. Or if you've had a hard money loan, you've definitely paid some origination points. So that's going to be some percentage of the loan that is paid upfront. Usually it's anywhere between 1% and about 3% of the loan amount. There's random fees. Just like any other business, there are some costs associated with being a lender. So for example, we will charge a $12.95 underwriting fee, and that actually covers all of the costs. So instead of trying to itemize everything out or just one number, I only have to keep track of one number at the end of the day. Super easy. But those fees usually cover things like your document prep. So if you want to have an attorney drawing up your legal documents, an appraisal or some sort of type of evaluation of the value of the property that's going to hold the lien, bank fees, wiring fees, recording fees, any of these little ancillary things that might pop up just kind of get lumped into one fee in our world. Then there's the annualized interest rate. This is the big show. This is what everybody worries about, and it's super funny to me. Like I mentioned, these are short-term loans. So think months, not years, right? So borrowers especially will really zero in on these annualized interest rate things. And I'm like, you're going to have this loan 6 months. Why are we arguing about a 1% difference on a $200,000 loan? Come on. It's 1% divided by 12 times 6. What are we doing? Come on. So the annualized interest is generally anywhere, I'd say on the low side is about 10%. On the high side is maybe about 14%. The variance is going to be obviously in the risk perceived in the loan. So loan to value, how well capitalized the borrower is, how much experience you think the borrower has, potentially the property itself. Is it a total gut job, or are they just going to go in and put paint and flooring? So those types of things will play into the annualized interest rate. The personal guarantee is something that this is on every single loan that we do. So generally as a lender, the lien is on the property. Again, since we're at the bottom of the capital stack, should something go wrong, should the deal go sideways, we are the first entity paid. If for some reason we are not made whole by the property itself, having a personal guarantee on that loan means we then have the right to collect that difference from the borrower themselves, whether that's the entity borrower or the actual person themselves borrower. That's what a personal guarantee is. So we are making sure that there's a personal guarantee in all the loans that go out the door for us. Like I mentioned, loan term, it could be anything that you want it to be. If you are someone that has some retirement funds stashed away and you're like, look, I don't want to do the churn. I don't want to review documentation every 6 months. I just want one solid property, one solid borrower, let them keep the property for like 5 years and just keep paying my monthly payments and it pads my retirement account. Cool. You could do a 5-year private money loan. Most loans are going to be somewhere between 6 months and maybe 18 months on the outside, with 12 being a pretty solid average. Lien position, you've heard me mention first lien position a lot. Most private lenders are going to be in a first lien position. There are some that will do a second lien position. I've done multiple second lien positions, but it's a very small circumstance where I think that's okay. So if you're interested in doing that, please, ping me afterwards. I'm happy to talk about that. But in general, especially for new lenders, I'm going to say be in the first lien position until you build that muscle memory, and then you can start kind of venturing outside the box. The loan to value is going to be anywhere, I'd say 75% is probably the high side. So that means 75% of what the value of the property would be for whatever the scope of work is. So for example, if you have a borrower that's going to buy the property, but they aren't doing a thing to it, they're just going to turn around and sell it, like a wholesaler would, then they're getting 75% of what they're buying it for, because they're not forcing any appreciation by putting in new flooring, new cabinets, new countertops, new bathroom tile, et cetera, et cetera. So I want to be at no more than 75% of the value of that property. And then lastly is construction holdbacks. So if you've ever gotten a hard money loan, you might be familiar with this. If you go in and say, hey, I'm buying this house for $100,000, I want to have $35,000 worth of repairs. I think the house is going to be worth about $200,000 when I'm done. The lender might go, okay, yeah, we'll lend you $35,000 for that repair, but we're going to hold it back. We're going to have it with a construction management company. Sometimes the title companies will do this. There's various vendors online that'll do this. And so basically you are kind of fronting the money for a certain portion, $5,000 for a new roof, $5,000 for a new air conditioner. You submit proof that work has been done. And then the lender goes, yes, I believe you. The work has been done. We've verified it. Here's $10,000 because you've spent $10,000. So it's not like if you're lending in this situation that they're leaving closing with a $35,000 check to have the best weekend of their life in Vegas. That money is being held back and it's making sure it's going into that property that you are lending on. And then just a little bit, in case this is something you think you want to take on your own and you're new to it, this is basically the way I would minimize risk in a loan. First off, you want to make sure you have legal documents drawn up by an attorney that is familiar with lending. And I stress this so much. Everybody and their brother wants to go to like the websites that you can go get legal document templates from and download it, or go ask somebody, because I get pinged for it a lot. They're like, hey, can I get a copy of your legal documents? No, it's not because I want to be a butthead. It's because my documents are drawn up for the states that I lend in the conditions that I lend in. Like, they are that specific. So if I go and give you documents for the state of Missouri for a business purpose loan, but then you want to go and close on a loan in Florida for something else, okay, those documents probably aren't even going to be legal in the state of Florida, because Missouri is a deed of trust state and Florida is a mortgage state. So automatically the title company is going to be like, we can't do this. So also, it's of no cost to you as the lender. Like I mentioned, we have that underwriting fee. Part of the underwriting fee is our cost for our attorney to draw up the documents. So it is of no cost to you to be protected. Because if you think about it, if you're doing a loan for $100,000, $200,000 or more, the only thing you are getting in place of that money is the legal documentation. So why wouldn't you want it to be the best you could make it that protects you the best? So please, 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 if you take nothing away from this talk, please don't use online template forms. Go and get the legal docs drawn up by someone that's knowledgeable about lending in the state the property is located in. The second thing is making sure the borrower has hazard insurance and making sure they have the right policy for hazard insurance. So for example, if they are doing a massive renovation, they're doing structural changes, they're adding a bedroom, but they go and get a landlord policy and something happens, the insurance company can deny that claim entirely because they didn't have the right policy to begin with. They needed a builder's risk policy when they actually have a landlord policy and it's not a landlord property. Or something happens to the property while it's vacant and they didn't have a vacancy rider in their insurance. Oh, guess what? Guess what goes up in smoke? So please, and then you're going to be added to the hazard insurance policy as a loss payee or mortgagee. So if they cancel, change, alter something, anything about their hazard insurance, you're actually going to be notified as the lender. Title insurance is another big one. Our borrowers pay for lenders' title insurance. Chances are, if you bought your own home, you have also paid for lenders' title insurance. It tends not to be terribly expensive. It's usually some percentage of the purchase price of the home or the loan amount, depending on which one you're looking at. So they buy lenders' title insurance. The lender's title insurance covers us as the lender. I usually advocate borrowers go and get owner's title insurance at the same time because it's usually a couple $100 if they issue it simultaneously to protect them as an owner. But lender's title insurance is not optional. Like I mentioned, that loan to value evaluation, want to make sure we have a really solid idea, good feeling, a conservative feeling of what we think the value of this property is going to be. There's a ton of different ways you can get that. You can ask for help. You can talk to brokers in the area. There's desktop appraisals. You could order a full-blown appraisal if you really want to go down that road, but making sure you have a solid idea of the value of that property. Like I mentioned, having a construction holdback, so they aren't leaving closing with any renovation money. That's a no, hard pass for me every single time. And then lastly, the promissory note. So most people might not realize your securitization instrument really is just outlining your claim to that particular piece of property. The promissory note is the thing that's actually outlining what the payments are going to be, when they're due, how they're made, who they go to, et cetera, et cetera, et cetera. So you need a promissory note and a lien instrument, the securitization instrument. And then just to give you kind of a breadth of idea of how you could potentially invest in private lending, investing in debt, I made a nice little diagram. So at the bottom is what I would consider most active, because remember, my personal mantra is I want to invest passively to live actively. So my goal isn't to be tied up doing things all day long because I have other things I need to be doing. And then top is going to be least active. So at the bottom, what I call originating and funding, which is what I do. So originating and funding, I'm going out and finding the deals. I'm talking to borrowers. We're underwriting the deals. We're preparing the documentation. We're dealing with the title company, insurance company, everybody. We're bringing everything together. Money goes to closing. Borrower goes to closing. We get documents back. Everybody lives. The second option is what I call brokering. So this is, again, a very wide area, so I can speak to my experience for brokering. But brokering is basically someone who will place capital into debt on behalf of someone else. So for example, someone in my network comes to me and says, I have $250,000. I really want to put into private lending because I want that monthly income for the next year because I'm taking time off to be home with my baby. Okay, cool. We can help. So we will find a borrower, we'll do the due diligence on the borrower, on the property, on the deal, and then we'll go to that person and say, hey, we have a loan for $250,000. Here's the high level details of the deal. Is this something you're interested in funding? Yes, no. They'll say yes, just in our example, to kind of move the deal forward. And then we'll prepare the documentation. The borrower will sign everything. It will close in that person's name. So that loan is that person's asset. It's not my asset. And why that's important is if for some reason something goes sideways, you have the claim to the underlying collateral for that lien. So if for some reason you need to default or foreclose or something, you have access, direct access to go, this is my loan, this is my lien on this property. Should something happen, you can be the decision maker. So that is how I do it. Brokering, again, is a very wide spectrum of like, I'm just going to connect you to, and I'm out of the deal, all the way to the loan actually closes in the broker's name, and then it kind of gets assigned to you after closing. There's a bunch of different ways to do it, but that's generally kind of how the flow looks. And then lastly would be something like a debt fund. Yeah.
Well, let me know when would be a good time to interrupt for questions. We've got people that are posting them in the chat, as they always do, and when you're ready, I'll just read them off to you.
Sure, I'll do it right after this debt fund explanation.
All right.
So For debt fund, I would consider the least active. So in a debt fund situation, it's going to be very similar to the LP syndication model. You're putting capital into something, you're essentially buying LLC shares is usually what you're buying in the syndication 506B, 506C route. There's a couple other regs that they could use, but that's the most common too. And in the debt fund model, you're not necessarily going to have a lot of transparency into what they're funding, what the metrics of the deal are, unless they're putting out that information as part of their investor relation package. But generally, they're just going to give you a framework of like, we have this amount deployed, we have this amount kind of coming in, your distributions will arrive on such and such a day. So it's going to be the most passive, but you're also, in my opinion, going to probably learn the least about investing in debt. But if you're not necessarily interested in learning a whole lot about how the mechanics of investing in debt, you just like the idea of being diversified and a little bit of equity and a little bit of debt, the debt fund option might be a really great route as well. So given that, Daniel, shoot, go for it.
All right. The first question that was asked is, what's the name of your Facebook group?
Private Lending Lessons. I actually have that on the very last slide. So it's Private Lending Lessons.
Okay, we'll get the link there. And next, you may have answered some of these already, so if you have, just let me know. But how do you qualify the borrowers?
The borrowers we are looking for, obviously, they have to have some capital because we're going to make them have capital in the deal in some capacity, whether it's a down payment, closing cost, or if they're paying for all of the renovation. So we want to make sure they have capital. Next, we want to make sure they have experience. So we are generally, just as a business, we are not working with first-time fix and flippers, first-time landlords. We want to see that you've done at least a couple of these before, just because I don't have children. Honestly, I don't really like children. The idea of trying to babysit adults is not that appealing. Again, I'm doing this to be more passive. So I would rather work with more experienced borrowers. As far as borrowers from the business entity side, we want to make sure that they have a signed operating agreement. We know who all the members of the operating agreement are. They have an articles of incorporation in their appropriate state. We make sure there's no liens, UCC liens on their entity in that state. So there's a variety of things we kind of do on the admin side. But also in our particular business model, we are very kind of white glove service. So we have a lot of communication with our borrowers. We're texting them. We have phone calls with them. We know them. I know their kids' names, kind of what they're doing. They post on Facebook they're super happy about, hey, look, we got the flooring and our new rental put in. So we have a lot of repeat borrowers. So chances are, a lot of our borrowers, we've done 2, 3, 4, 5 different loans with them. So they're people we actually know really well. We've developed a relationship with them. We're still doing due diligence on them, obviously, but it's just a different relationship when you're dealing with someone who's like, yeah, I love working with you. I found another property. Here's the address. Is this something we can work on? Yes or no?
I'm going to throw in a question here, actually.
Sure.
A lot of states, you need to be licensed in order to lend. Do you have or know where to find a breakdown of what you need to do legally in order to become a lender in a state?
So that's a great question, and it depends. In the scope of what we are lending on. So you heard me mention we do business purpose loans. We are not lending on somebody's primary residence. We aren't even lending on somebody's second home. So if they're spending more than 14 days a year at their short-term rental, that's considered their second home. We don't lend on that because those things come with federal regulation, consumer protection. Those require licensing all the time, every day, every state. In the type of lending we are doing in business purpose lending, because we are lending to businesses to buy investment property that they will not occupy, that is actually controlled at the state level. And all 50 states have different licensing requirements. The vast majority of the states, in some capacity, do not require you to have a mortgage broker's license. If you are lending your own money, to my knowledge, other than the state of California, they don't require you to have a license at all. If you're brokering other people's money, there's lots of little caveats. So that's why I say really talk to an attorney that's familiar with lending in that specific state. Because just as an example, in the state of Virginia, I don't need a license in the state of Virginia as long as I lend on property that is going to be investment property only, and the borrower is a business entity. I don't need a license. In the state of Virginia, they have this funny little caveat, though, is I can do up to 4 loans a year not being licensed, lending to individuals on residential property. But if I do more than 4 and I'm lending on residential property to individuals, I need a license. So what do I do in the state of Virginia? I just lend to business entities, and that's my lending criteria. You have to be a business entity. So in some states, it's not a blanket yes, no, on, off. There's some little nuances that you have to pay attention to.
I know the majority of people that are in this group are in California, Washington, or Arizona, and
Yep.
I know that California and not Arizona, Oregon. Oregon is a licensed state as well.
Yep. So a lot of people that I know live in California that are private lenders, they actually don't lend in California because the lending regulations are just, it's California. I've lived there. You guys live there, you know.
Yep.
It's California.
And
So
you
they
can
will
answer this
actually,
question. Oh, go ahead.
I was going to say they live in California, but they will lend. One of my very good friends, he lives in California, lives in the Bay Area. He lends in Indiana because he's very familiar with that state. He used to live there. He's got boots on the ground. Another one of my friends lives down in LA, loves California, loves to surf, will never leave California, but he actually lends in Ohio. So you just because of where you live doesn't necessarily mean you have to be a lender in that area.
Yeah, and actually, before I joined Intel, which was in 2010, I was a volunteer over in Europe, and my wife and I lived over there, and we lended to properties over in the U.S. from Europe,
Yep.
and that was how I was able to make ends meet being a volunteer overseas.
Yep.
You can answer this quickly. The loan is secured by the property. Do you ever secure based on the borrower?
In some capacity, we have the ability to do what's called a UCC lien. So if we felt we needed some extra oomph, we could do a UCC lien on the entity itself. Generally, what we're going to do is if we feel like there's not enough safety for us in that particular deal, we could actually do what's called a cross collateralization. So you put more than one property kind of associated with the mortgage. So if they have a ton of equity in a property they already own, we could say, okay, cool, we'll do a lien on this property and that property. And then basically, if something goes wrong, you have a legal claim to actually both properties. So instead of kind of going after the borrower, we'll choose to recollateralize with another property. All
right. And there are a couple of questions along the lines of, it seems that your lending time is very short, 12 to 6 months. And are these really more geared towards construction loans, or do you lend on rental properties that are longer term?
So some of these properties are rentals. So for example, during the COVID time, real estate was super competitive. Stuff was just flying off the shelves. So what people were doing was they were using private capital to make cash offers and being able to close in a couple of days. So there might not have been anything wrong with the property. There's nothing wrong with the borrower. They just wanted to put in a more competitive offer. So they chose to do it with private capital by being able to give a cash offer, because we would be able to tie a deal together in a matter of a couple of days. Really, title's usually our slow point. So as long as title is ready and clear, we can close. So it's not always just property that needs significant renovation. Some people will actually do this in conjunction with the BRRRR method, is they will use this to actually buy rentals, because like I mentioned, we'll do 100% of the purchase price as long as it's below about 70 or 75% of the after repair value. So if you have an investor that's been going out there doing cold calling, following up with sellers, they have motivated sellers, if they can find 2, 3, 4, 5 really good deals in a year, instead of going to the bank that's going to make them put down 20% of the purchase price, because they're buying it at such a good deal, they can come to us, get the acquisition for it, hold on to it, get it seasoned. It's rented, it's ready to go. They get it seasoned for about 6 months, which is what a lot of the conventional lenders want. And then they'll refinance it. So they can essentially go into a property with very little down because they bought it with a bunch of equity. So we actually do get people buying rentals this way.
All right. We do have quite a number of other questions, but I want to make sure you get through your presentation as well. So
sure,
we'll hold off for a little bit.
Okay. I just got a few more. So I just wanted to bring this up because this, I think, intrigues people, because if someone's in a position where potentially they don't have $200,000, $300,000, $400,000, that they want to necessarily throw into this one type of investment or maybe just one asset, one loan, is you could do what I call a lending club. So what happens is, I'm in this example, it's 4 people, A, B, C, and D. Everybody can put in a certain amount of capital into a business entity. I say LLC, it could be anything. And then those 4 people are basically the owners of that lending LLC. So it could be 4 different amounts. It could be 4 same amounts. Everybody puts in 50,000 and you have 200,000 to lend out. And basically what this does is it allows people with smaller amounts to be able to be in a first lien position, but it also potentially allows diversification. So think about if you have 4 people that come together with $100,000, instead of having one $100,000 loan, you now potentially could have 2 or maybe 3 different loans because you've pooled that capital together. So I really like this model. This is actually how I started my most recent lending business with 2 other military spouses. Is we formed a lending club and then started lending out our own capital. So I particularly like it. I'm kind of partial. It's worked so far for me. Not an attorney, not legal advice, but just showing you a framework that could make it possible to have involvement in private lending, but not necessarily have 2, 3, 400,000 available to do just this type of asset investment. So just a little pictogram of what would happen. The easiest thing is to pick one person that's kind of going to speak for the group. I chose person D because I think person A gets all the fun all the time. So person D, in my example, is the person that's going out and deciding, are we going to invest in a debt fund? Which debt fund? They kind of go out, get the information, bring it back to the group in my mind. Same thing with brokering. Person D would find somebody that they want to broker with. Maybe they look at past deals, they ask all the questions, they bring it back to the group. Or potentially person D or the group decides that they want to do origination and funding on their own. So again, that one point of contact for a borrower or the title company, et cetera, will make things much more smoother. So origination and funding could also be an option. You bring it back to the group. And the reason I say do this, as opposed to just 2 people coming together and you're both on the loan, that's actually called fractional loans. In most states, that's considered a security, especially if you don't know each other. Now, if husband and wife, or 2 friends that have been lifelong friends, you have a pretty substantial pre-existing relationship, you could go in together on a loan. You're both named on that loan as co-owners of this particular lien. In this model, you've kind of taken that a step back because now you're all owners of the LLC. In the privacy of your LLC and your operating agreement, you can outline what the ownership percentages are. You can outline who's going to put in what capital. You can outline where the distributions are going, when the distributions happen. You just have a lot more control and a lot more privacy if you've taken that fractional ownership and you've taken it backwards into an LLC as opposed to having it forward facing, because you got to remember that securitization document is public record forever. So if somebody goes and Googles your name, if you've closed in your own name, you now have it in public record forever, your name tied to a whole bunch of assets of liquid dollars, even if it's a fractional amount of money. And that also has your address on there. So if you're operating through an LLC, you get a little bit of that anonymity.
That's an important thing to do, especially if you ever get to a situation where you might face a lawsuit, because lawyers will look for people that have a lot of assets in their name.
Yep. And the public records, you can't get it taken down. So
hey, one really quick question.
Sure.
Several people asked, why do you actively manage your own funds rather than work with a debt fund? Or why do a lending club rather than a debt fund?
So the debt fund, like I mentioned, you don't have a lot of control of what the capital's going to. Whereas when I'm brokering or placing funds, I know the borrowers, I know the projects. And for example, my lending business is entirely women owned. A lot of our borrowers, because that's the people in our network, are also women. About 25 to 30% of the real estate investors out there are women. So we're helping a minority of group get into a better financial position. And that just makes me feel better. Like I want to do something that fulfills me as a human being and make money. Are debt funds doing that? Maybe, maybe not. I don't know, because usually in a debt fund, you're not going to have that level of transparency. They're usually going to tell you metrics like, this is the amount of percentage we have deployed. This is the amount we got in payments last month. This is the amount your distribution is going to be. We've had 0 defaults. We've had 5% defaults, whatever it is. They're not showing you, hey, we lent to Barbara and she bought 123 Main Street. She then refinanced it 8 months later, and now she's got a property that's got $60,000 worth of equity, and it's making her $500 a month. Whereas that's an actual scenario in my world, and I know Barbara, so it's a feel good thing for me. But also, when it comes to taxation, depending on how the debt fund is structured and how they're claiming the income, it could be active income, it could be interest income, it could be business. So whereas in the brokering and origination model, it's interest income all day long.
All right. Do you want to go on with your presentation, or should we hit some questions?
We can hit some questions. I'm game. This was just a little example for numbers, so I can leave this up and answer questions.
Okay. Okay, we can do that for a little bit. And then after a while we can switch to your contact information if you've got
Sure.
a slide for that.
Sure.
All right. So just taking it from the top here, Anita's asking, how much capital should a person have to start?
Generally, I'm going to say if you want to do it by yourself, you want to originate, you want to be a whole note lender, I would say about 100,000, maybe 120,000. That's what we use as our minimum, because we're looking at being in a first lien position, first off, but also you want to be in a first lien position on an asset in a market that if something happens, you don't mind owning that asset. So if we have some multifamily investors here, you're probably familiar with the term a D-class asset in a D-class neighborhood. Could you potentially do it at a lower amount and still be in a first lien position? Absolutely. But just the run up in values we've seen, especially kind of since COVID has happened, a lot of the markets that were, you could pick up a house for 20, 30,000. Even those markets are now up at 75 and 80,000 for starting price for buying investment property. So I personally would say 100,000 to about 120.
All right. Can you tell us a little bit more about the insurance that you require the borrowers to have?
So the borrowers have to have actually two different types of insurance. So they're going to have hazard insurance, which is going to cover the property. And we actually have a liability component with that hazard insurance. So if somebody happens to get hurt on the property, the owner, the borrower, has some sort of liability coverage. We require $1 million worth of liability coverage with ours, because the hazard insurance is effectively protecting their financial position in the house. So we want their financial protection because they're the ones paying us. So if, a tenant slips and falls and decides to sue them for, medical damages and pain and suffering, et cetera, we want to make sure that they are financially protected. So we have hazard insurance that also has a liability component. And then we also require, like I mentioned, title insurance. So title insurance is a little different. It's going to cover events that are previous to the closing day, not from the closing day forward. So previous to the closing day, if grandma pops up 4 months into this loan and says, hey, somebody forged my signature, I actually didn't sell this house, this is still my house legally, then theoretically, if there's not title insurance, then that lien can be totally forgiven because it's an illegal loan. It was an illegal real estate transfer. So title insurance is protecting the lender's lien if you're getting a lender's title policy. And then that's why we also have the borrowers, we suggest to the borrowers that they get owner's title insurance. So if grandma does pop up, the owners aren't also out all the money that they have put into the property.
All right. What type of commission do you charge for brokering a deal?
So we call them capital partners. For our capital partners, there's actually no cost to have the money brokered in our business. That's not the case for all brokers. We are actually paid by the borrower. So in our business model, there is no cost to the capital partners at all. They also get all of their interest. In some cases, the broker will take what's called a point spread. So if the note rate is 12%, maybe 25 basis points, 50 basis points are going to the broker, and then you as the capital partner get the rest. So we are paid exclusively by the borrower. There's no cost to capital partners to have capital brokered.
That's good. That leads us right into the next question, which is, do you borrow funds to loan to borrowers? From what sources do you borrow money? Do you need to secure these loans with capital or equity? And can you, in theory, borrow and loan out an unlimited amount over time?
So I think I know
quite a
where
few
you're going with
questions
this.
in one.
Yeah.
one chapter.
So I think potentially what you're asking about is sources of capital, potential sources of capital. So yes, you can borrow capital So for example, if you wanted to build a business line of credit, you open your own LLC, but you build a business line of credit, you can then turn around and lend out that capital. And whatever the difference between what you're paying and what you're getting, it's called a delta. So for example, if you borrow $100,000 at 6%, and then you lend out $100,000 at 12%, you're keeping that 6,000, or that 6,000 over the year, but 6% difference is yours. So you're basically earning 6% on money that wasn't even yours to begin with. So yes, it is possible to borrow a capital. Some brokers will do this where they'll have a capital partner do basically a loan to the business, and then the business turns around and lends out that capital to the borrower. I don't particularly subscribe to that model because I want my capital secured directly against property, not against a lending LLC. But that is another model out there in brokering. We just don't do it. So to answer your question, yes, it is possible to borrow capital. Some people will kind of bring in their friends and family, kind of an unofficial lending club situation, and they'll say, hey, can I borrow $50,000 so I can, mix it with somebody else's $50,000 and someone else's $50,000, and I'm going to do a $150,000 loan. So that, yeah, that's entirely possible.
Okay, next.
Daniel, can I chime in? Because that was my question.
Yeah.
So do institutional loaners, bad vocabulary there, are they able to loan to you so that you can loan to others? So for example, could you go to Bank of America, borrow at 6%, and then loan this out at 12%, and then leverage your whole business to do it all over again for a future borrower?
Not at the beginning, not in my experience. They're going to want to see some track record. It's called loan tape in our industry. So they're going to want to see some loan tape to see, what your underwriting standards are, how have your past loans performed, what has been the interest rate that you've been able to garner for past loans. So I would say probably 2, maybe 3 tax returns showing some strong revenue growth. They're going to want to see individual loan documents and that kind of thing, but it is possible. But right out of the gate, something like Bank of America or Chase, if you're interested in doing something like that, I would say look for small, local, regional banks. They tend to be a little more lenient than somebody like Bank of America or US Bank or Wells Fargo, the big national guys. Because realistically, at that point, you're in direct competition with them because they run hedge funds and trading desks and the whole 9 yards. So if you're going to potentially look at leverage, taking on leverage, I would start with kind of the small community bank, and they're going to want a banking relationship. So if you open an LLC and you deposit $100,000, and then you go to them and say, hey, can I establish a business line of credit with you, even if it's something small, $10,000, right? That's actually what our first business line of credit was years ago, was $10,000. And we just kind of every 6 months, every 12 months, we kind of nudge them and we say, hey, we've used this, we've put it back, we've used this, we've put it back, we've been very responsible. Can we have this upped? And finally, we got it. The most recent up we got it to was about $200,000. So, and it started at $10,000 probably 5.5 years ago now. So as long as you build some loan tape, you have that banking relationship with them. And again, they're a small local bank. They tend to be a little bit more responsive than somebody like Wells Fargo or Chase.
Okay. All right. Thank you.
All right. Just so everyone knows, we've got 6 minutes left in the meeting. And there were a couple of questions around, can you give us an example of a time when things didn't go well?
Oh, yeah. So in general, again, this is one of the downsides of private lending. All 50 states are all different. But in general, most people consider worst case scenario is foreclosure. In reality, if you're lending in the right way, foreclosure could actually make you more money than them performing on the loan, but I'll let that go for another day. But if something were to happen, again, you have strong documentation, you have a secured lien, you have hazard insurance, you have title insurance, you've checked all the boxes going into this deal. If something were to go wrong and they default, in most states, you have to do what's called a notice of default. So for example, we just have an attorney that handles it for us. We've never had to do it, knock on wood, but notice of default basically puts the other party legally on notice that they are in default of the terms of their promissory note. And so they generally have some time frame. Sometimes it's a week, sometimes it's up to 30 days. to basically cure or quit. So they have to fix it or they have to refinance it and pay our loan back. If that doesn't happen, then you start down the path of foreclosure. We just hire an attorney. We have an attorney, for example, in the state of Missouri, it's $3,500. We talk to him. He explained the process to us. He just says it's a flat $3,500. In the state of Missouri, foreclosures can happen in as little as 45 days. In other states, it could potentially be years. So, like, another reason to pay attention to the state that the property is located in. But the foreclosure process essentially is it's a non-judicial state. There's no like judge affirming anything. It's literally paperwork. It goes, if you ever heard of buying a house at the courthouse steps, an auction, public auction, that's what's happening. Lenders have put that collateral essentially up for sale to be made whole according to the terms of their legal documentation. Theoretically, if you're not into the property too much, somebody is going to show up at the courthouse and buy this property for more than what you have put into the auction to say, hey, we have $100,000 rolled into this property. Our minimum bid is $100,000. So if nobody meets that minimum bid, worst case scenario, you get the property back. It is now yours to do with what you please. If you've ever heard the term REO, that's what an REO is. It's a property taken back by a lender. So if you're already familiar with real estate or you're lending in an area where you're already investing, worst case scenario, you end up with a house if that's what you're lending on.
All right. And then Glenn, you may need to clarify this question a little bit, but Glenn's question is, what is your view on the pyramid, going back to your triangular slide? The same rate regardless of fees generated at the top and at the bottom. What's your opinion of the fees generated at the different levels along that pyramid?
So,
Glenn, feel free to clarify that a little.
Yeah, sure. So from active to passive in your pyramid model, right? I'm assuming that your belief or expectation would be that the aggregated return on a more active investment is going to be higher than it is on the passive side. So is generally the rate the same regardless of where you are in the height of the pyramid, and the rest of it is really sort of fees and ancillary type stuff that generate the return difference, or is it something different?
It's generally going to be the more active you are, the higher the return is going to be on your capital. So for example, if you are originating, like I mentioned, we charge between 2 and 3 origination points. We charge $12.95 for an underwriting fee. And then let's just, to keep numbers easy, 12% is an annualized interest rate. So if we add all that together, if they kept the loan over a whole year, that could potentially be 14, 15% of a return in the course of that year. If we're originating, we kind of don't want them to keep it the whole year, because if we get it back in, then we can turn it and put it back out for another 2 or 3% origination. So theoretically, the more active you are, you can theoretically make more. The debt fund model has the benefit in that if you're someone that doesn't like that churn, you don't want the churn, you just want like nice, steady, consistent. The debt fund model, I've seen debt funds anywhere, I would say the average is probably about 7%, maybe 8%. There's a couple I've seen lately that are about 9%. That's supposed to be the annual return you're getting through distributions. Cool. I don't necessarily look exclusively at the return on the debt funds, because they could be doing second liens on doctors' offices, or hotels, or some other asset. The higher the return they're promising you, that potentially translates through to they are taking on riskier loans to pay that higher return. And because I don't have that level of transparency to be able to go, hey, I'm not comfortable being in a second lien position at 95% combined loan to value on this retail complex. I'm not comfortable with that. You don't have that level of transparency in a debt fund. So not to say they're bad, but they do have the benefit of your money is deployed the entire time it's in the debt fund. It is earning interest the entire time because it's actually bought shares of this debt fund.
Thanks.
All right. And then last question, and it's actually 3. How many loans have you made? What's your total AUM? And how many are non-performing?
So probably total, I've done it off and on for a number of years, not necessarily super formalized. So I would say maybe 50, probably formalized as a business entity in the last 3 years, 2 years, 2 years, as our current business entity. Assets under management, that one's not 100% accurate for us because we do a lot of brokering. So we have our own capital, we have our own loans that are, we call them equity loans that are out there on the street. So from an equity perspective, I would say we've probably done 2 million in equity loans in that time frame. But a lot of our model is brokering. So we're closing loans in other people's names. So it's not necessarily building loan tape for us. We build loan tape through equity loans. So asset under management is not necessarily a metric that's going to be super helpful in our particular business model. And what was the third question? There might have been
how many are
after that.
non-performing?
So non-performing, again, another it depends question. We have not had a borrower not pay. Have we had loans go into default? Technically, yes. So for example, very early on when COVID was happening, supply chains were having a problem. And so we had a borrower actually go over his time because he could not get windows in to save his life. So he literally ordered windows the day he closed, and it took 4 months for his windows to show up. And then they went through the process of selling it to a retail buyer. So he was technically in default because he went over his 6-month time frame. He was in communication with us. We modified the mortgage. He paid an extension fee. We got the deal done. We had another borrower. His insurance company dropped him and then mailed notification to the fact that they dropped him to his ex-wife instead of him. His ex-wife did not tell him. And so his insurance lapsed. We got notification his insurance lapsed, and that's technically in default of our loan because they're required to have insurance at all times. So we got on the horn with him and said, hey, you don't have insurance anymore. So technically that loan went into default for insurance reasons, but he was paying the whole time. So I would say non-performing, when you're talking about non-performing specifically monetarily, we have not had a borrower just kind of disappear and not pay. Like I said, a lot of these borrowers, we have an established relationship with them. We have their cell phone numbers. They have my cell phone number. So, and they're repeat borrowers. They're people we've worked with multiple times.
All right, everybody, can you take yourselves off mute and thank Alex for coming in and speaking to us today?
Thanks,
Thank you,
Alex.
Alex.
Thank you, Alex.
Thank you, Alex.
Thank you.
Appreciate it.
Yeah,
you, Alex.
Feel free to
Thank
reach
you.
out anytime. I really enjoy talking about this kind of thing. So feel free to reach out. That's my email address. And I'm happy to spend some time. I have a Calendly link. We can book some time one-on-one to kind of talk you through this private lending process.
Also, if you know of any speakers that you think would be good for a fit for this club, feel free to let me know. I am looking for additional speakers. Have a good weekend, everyone.
Thanks.
Thanks.
Have a long weekend.
Daniel.
Bye.
Thanks, Daniel, for soldiering through. Thank you.